Have you ever noticed how the most secure investments often emerge from the most insecure places on the planet? Right now, a brutal war in Eastern Europe is quietly rewriting the rules for a specific corner of the market. And if you're not paying attention, you're missing a fundamental shift in how defense stocks behave. This isn't about fleeting spikes based on headlines. I'm talking about a structural, multi-year realignment of capital driven by geopolitics that has created what I believe is a new investment paradigm. The war in Ukraine has moved from a shocking regional conflict to a grinding war of attrition, and that transition has profound implications. It has transformed defense contractors from cyclical boom and bust plays into something closer to essential infrastructure stocks. Let me explain why. For decades, the business model for major defense primes like Lockheed Martin, RTX, and Northrop Grumman was predictable. They'd lobby for big, multi-year contracts for next-generation systems, a new fighter jet, a submarine, a missile defense network. Development took years, production trickled out, and stock prices moved with the political winds of Pentagon budget cycles. The profitability was in the sophisticated engineering, the proprietary technology. War was seen as a tragic but occasional event that could cause a short-term bump in ammunition orders. The core business was about selling a deterrent, the shiny sword on the wall. But Ukraine changed the calculus completely. It didn't just demand the shiny sword, it demanded an endless supply of the most basic nails. This conflict has become a brutal consumer of artillery shells, drones, tactical missiles, and armored vehicles. It's a war of industrial capacity. And here's where it gets interesting for your wallet. Western militaries, particularly in Europe, looked into their stockpiles and got a cold shock. They were prepared for a short, high-tech war, not a years-long artillery duel. Germany's defense minister famously stated they had enough ammunition for maybe 2 days of intense combat. That wasn't a procurement error, it was a philosophical one. Therefore, governments are now engaged in a historic pivot. They're not just ordering more bullets, they're rebuilding the entire industrial base to produce them. The U.S. Army is aiming to boost artillery shell production from 14,000 a month to over 100,000 by 2025. The European Union has a plan to deliver 1 million artillery shells to Ukraine. This isn't a one-time purchase order. This is the creation of new production lines, the reopening of shuttered factories, and the signing of multi-year guaranteed offtake agreements. For defense companies, this provides something they've rarely had: unprecedented revenue visibility. The demand isn't speculative, it's contractually locked in for years to come. This shifts their earnings from being event-driven to being almost utility-like. I think this is the most underappreciated financial story in the sector. The market initially treated defense stocks as a simple war premium trade. Stocks popped on bad news, dipped on talk of peace, but that's a simplistic, outdated view. The genie is out of the bottle. Even if negotiations started tomorrow, the strategic lesson for NATO nations is indelible. You must have deep, resilient stockpiles. The era of just-in-time military inventory is over. This means the baseline demand for what I call consumable defense, artillery, missiles, drones, and the components that make them, has been permanently raised. Now, let's translate this into portfolio strategy, because not all defense plays are created equal. The first tier is the direct beneficiaries of the replenishment cycle. Companies like BAE Systems, Rheinmetall, and General Dynamics Combat Systems Division are at the forefront. Rheinmetall, for instance, is building new plants in Germany and Hungary and saw its order backlog swell to over 40 billion euros. Their stock chart looks less like a defense contractor and more like a tech growth stock over the past 2 years. But is it too late to buy? I don't believe so, because we're still in the early innings of actual production ramp-up. The capital expenditure is happening now. The full profit stream comes later. The second tier is more interesting and involves the enablers. This war has been dubbed the first commercial drone war. Cheap, off-the-shelf drones from companies like DJI have been weaponized with devastating effect. But the next phase is about military-grade, swarm-capable drones and the counter-drone systems to stop them. This is a brand-new, fast-growing subsector. It's not just about the big primes. It's about smaller, agile players like AeroVironment or private companies soon to go public. Investing here is more speculative, but offers pure-play exposure to a transformative military technology being validated in real time. And then there's the third, most crucial tier, the supply chain. This is where I see hidden value. For every Javelin missile made by Lockheed and Raytheon, there are hundreds of specialized components: seekers, guidance chips, rocket motors, specialty steels. Companies like HEICO Corporation, which makes replacement parts for aerospace and defense, or Mercury Systems, which handle secure processing, become essential cogs. Their businesses are less volatile, often with higher margins, and they benefit from the production increase across multiple prime contractors. It's a diversified bet on the entire sector's expansion. But, and this is a critical but, this isn't a risk-free paradise. Geopolitical risk cuts both ways. The primary risk isn't peace breaking out, it's political fatigue. Aid packages, especially in the U.S., have become political footballs. Delays or cuts can disrupt the smooth flow of contracts and create quarterly volatility. However, I believe these delays act as a pressure cooker. They don't diminish the underlying demand from militaries. They just postpone it, potentially creating even sharper surges in orders when log jams break. The financial imperative for European nations to arm themselves is now a national security consensus, making their spending particularly resilient. So, what's the practical takeaway for your portfolio? First, understand that defense investing now requires a new lens. Look for companies with significant exposure to munitions, replenishment, and the European theater. Second, think in terms of timelines. The replenishment cycle will last for at least 3 to 5 years, creating a runway for earnings growth that is unusually clear. Third, consider diversification within the theme. Instead of going all in on one prime contractor, look at an ETF like the iShares U.S. Aerospace and Defense ETF, ITA, to capture the whole ecosystem, or actively build a basket that includes a prime, a munitions specialist, and a technology enabler. My personal opinion, we have entered a multi-year super cycle for defense that is fundamentally different from the past. It's being driven not by a desire for technological superiority alone, but by the urgent need for mass and industrial endurance. This transforms the investment case from speculative to structural. The money flowing into these companies isn't just funding war, it's funding a profound and lasting change in how Western democracies provide for their own security. That is a trend with financial weight. The battlefield in Ukraine is tragic, but on the financial markets, it has drawn a new map. One where the roads all lead to factories with long-term contracts and overflowing order books. For the alert investor, that map isn't just a picture of conflict, it's a blueprint for opportunity. As always, this is analysis, not financial advice. Do your own research, understand the risks, and think strategically.